Hello, everyone, and welcome to the 2026 tax update for mergers and acquisitions. It's part of the quarterly Perspective on Tax Law series. My name is Mike Coburn. I am a partner in the Vancouver office of Fasken, and I'm joined today by my partner, Chris Ross, who's also in the Vancouver office of Fasken. We're going to talk about a number of tax issues relating to mergers and acquisitions. This has been something we do annually, mostly trying to focus in on developments in law as well as trends we're seeing in practice. Before getting into the substantive content, though, there is a little bit of administrative material I wanted to go over. The presentation materials can be downloaded via the handout tab. At the end of the presentation, there'll be a QR code that will direct you to where you can get a certification for attending the conference for closed captioning. If you want to turn on the closed captioning, please click the CC button under the video window. There is a survey, and we very much would encourage you to complete it. We always look at those very closely and try to find ways to improve these presentations going forward. Do you have any questions? And we very much welcome questions. Always make for better presentations, I think, if we get questions. Please put any questions for the speakers in the questions tab. And finally, if you need any technical support, please click the tech support button at the bottom of the video window page. So moving on to our presentation today. We're going to talk about generally 5 different areas. Chris is going to go through a specific type of planning that is we see quite often in the M&A context, and we refer to it as 111(4)(e) planning, which is the paragraph of the Tax Act that sort of drives that planning, and Chris will walk through that. He'll also walk us through earn-out issues. Earn-outs are always an important part of M&A transactions, and there are always tax issues arising from earn-outs. I'm then going to go through an update on the mandatory disclosure rules and what we're seeing there as in terms of both practice and what the CRA has said in recent months on those rules. I'm also going to talk about some common due diligence issues and walk through those, and we'll wrap up with a discussion of locked box agreements, which is a sort of a trend we're seeing and the tax implications out of that trend. But to start with, I'm going to turn it over to Chris to talk about 111(4)(e).
Thanks, Mike, and hi everyone. Good morning, good afternoon. Glad to be here today. So as Mike mentioned, I'm going to start by talking about what's known as 111(4)(e) planning. If I can get to the next slide. Okay, so what 111(4)(e) planning, just at a sort of high level, it's a form of pre-closing plannings that the vendors of a target company can undertake where they're selling the company to a buyer in the M&A context. So it's a form of kind of pre-closing planning, and most typically you'll see it where the target company that's being sold has NOLs or operating losses for tax purposes. And what at a high level, what this kind of planning does, it basically allows the vendors of the target company who are selling their shares to make use of, to benefit from the target company's losses by essentially increasing the tax cost of their shares that are being sold, which in turn reduces the gain on the shares that are being sold. So with that, you can see it's a fairly it's a fairly good mechanism for vendors of the target company. And so I'm just going to walk through a little bit about sort of how it works. It's not a particularly new form of planning, but we are seeing it quite a bit. And there are certain issues that are starting to crop up more often with this kind of plan that we're starting to see. So that's kind of why we're talking about it today. So to go into a bit about how it works from a slightly technical perspective, trying not to be too technical here. Okay, so how it works. So at sort of a high level, the target company will basically trigger a capital gain in its final tax return before the acquisition of control, and it triggers that capital gain under this provision that Mike mentioned, paragraph 111(4)(e) of the Income Tax Act. I'll return to that concept of what exactly I mean by triggering a capital gain a bit later, but for the moment, the point is the target company can use this provision to trigger a capital gain, and what that does is, so just to just to give an example, let's say, for example, the target company has $100 of operating losses. And it wants to make use of it with this planning. The idea would be the target company could actually trigger a capital gain of twice that amount, so a $200 capital gain. And then the difference there is operating losses are fully deductible, whereas capital gains are only half includable. So in theory, if you trigger a $200 capital gain, that results in a $100 taxable capital gain. $100 is included in the income of the target company. At that, in its final tax return before the acquisition of control, while it's still with the vendors. And so at this point, now the target company has a $200 capital gain and a $100 taxable capital gain and $100 of losses. So what it does basically is the target company applies its $100 of operating losses to fully offset the taxable capital gain. So this planning is not intended to trigger actual cash tax in the target company. The point is it triggers a gain, it uses up its losses to offset the taxable portion of the capital gain. And so there's no cash tax. So that's sort of the first kind of step. But the other thing that the capital gain does in the company is, going back to where we have a $200 capital gain, half of that $100 is taxable. The other half goes into what's called the company's capital dividend account, or CDA. And it's sort of a notional tax account, with the idea being only half of a capital gain is taxable. And so at the company level, they need to sort of preserve that treatment when the income ultimately gets flowed out to the shareholders. So at this point, the company now has $100 of CDA as well. And the importance of CDA for tax purposes is that it allows the company to pay that amount out to shareholders as basically a tax-free capital dividend, hence the name capital dividend account. And so at this point, the target company is sitting there with no more losses, no more income, but $100 of this CDA. And so then what it can do is it can basically pay a capital dividend, a $100 capital dividend to the shareholders, which the shareholders will receive, but not actually be taxable on because it's a capital dividend. So the shareholders are not taxable on that $100. But the other thing that capital dividend does is it increases the tax cost of their shares by $100 in aggregate in this example. And so from the shareholder's perspective, I've now received a $100 dividend and I'm not taxable on, but it's also increased the tax cost of my shares by $100. And so when I then sell my shares in the transaction, my gain has been reduced by that amount. And so that's sort of the mechanism as to how the losses of the target company are used to increase the tax cost of the shares. One point on the capital dividend piece, I have it in brackets that this is sort of a notional capital dividend, and I think that's fairly important. So, you might be asking, how does the company sort of pay a capital dividend? Is it paying anything? Is it actually distributing anything? And the answer is no. So the legal mechanism that we typically use to sort of trigger that capital dividend, so to speak, is legally the target company can basically pass a director's resolution. In BC, at least, I'll pause for a second. So in BC, the way to trigger capital dividend can be a little bit easier than in certain other jurisdictions. But in BC, the way that works is the target company would basically pass a director's resolution saying we're increasing the legal capital of the subject shares by $100 in this example. And that doesn't require a payment, a distribution. It doesn't require the company to receive anything. It's a paper addition done by director's resolution to increase the capital. And when it does that triggers, for tax purposes, a dividend of that amount. And then the step is, well, now the company can basically designate that deemed dividend to be a capital dividend. So it all sort of works nicely in that sense. There's no actual payments or distributions that are being made. But the vendors can make good use of the losses of the target company in this way. And that can of course be a huge benefit, as you can imagine, especially in Vancouver. We deal with a lot of tech companies. Often they do have operating losses. And so that's a pretty important type of planning. So that's on sort of the vendor side of the equation. And you might then be asking, what about the buyer in this case? Does the buyer care about this? How does this affect the buyer? Should you expect pushback from the buyer? And so the consequence of this is that, well, if you don't do any planning and the target company is sold with its losses to the buyer, in Canada, we have so-called loss streaming rules that basically they restrict the ability of a buyer to use the sort of pre-acquisition of control losses going forward. But in general, as long as you comply with those rules, the buyer can still use those losses. So to go back to our example, where the target company has $100, for example, of operating losses, and no planning is done, well, the buyer can acquire this company, and now the buyer can, in theory, at least make use of those losses. If you go do this planning, well, the losses are gone at that point. So it does affect the buyer, and so often what we start to see is the vendor will go about this planning. They'll start talking to the buyer about it. The buyer will say, well, hold on a second. I mean, a critical piece of the company that we're looking for was these losses. You can't just sort of use up these losses. And so this brings up this question of, well, whose losses are they anyway? And so one piece is, well, sometimes you look at the LOI. What does the LOI talk about it? And more often than not, it's silent on it. So you get into this sort of negotiation piece. And I'll come to sort of a possible takeaway after this, which is consider addressing losses in the LOI, especially where they're particularly important, either to the vendor or to the buyer. But the last point I'd like to talk about, which this is coming up a fair bit in transactions, is there is sometimes a way to sort of bridge the gap between the vendor sort of getting the benefit of all the losses with the buyer getting effectively nothing. And this comes back to my point about sort of how 111(4)(e) actually works. Like, what does it mean to sort of trigger a capital gain? And the way it actually works is the provision in the Tax Act basically says the company can identify a particular capital property that it owns, including goodwill, which I'll come to in a sec. It can identify a particular property and basically trigger a capital gain on that particular property up to the fair market value of the property. And so often when a company is kind of going through its balance sheet and they can't necessarily identify certain assets which have this kind of accrued gain, they'll go to goodwill and they say, okay, well, goodwill being the difference between the fair market value and the fair market value of your identifiable assets, and they'll say, okay, well, I'm just going to trigger the gain on the goodwill, and the CRA accepts that, and that's generally fairly non-controversial. The result of that is that the gain that they trigger on the goodwill becomes the tax cost of the goodwill to the buyer. And goodwill in particular has a very slow or very low rate of depreciation, tax depreciation that you can claim on. I think it's 5%. And so in that situation, the buyer is essentially trading 100% deductible loss for a 5% deductible tax depreciation rate. So that's where the tension comes. Software, on the other hand, it benefits from fairly highly preferential tax depreciation. So it's 100% deductible. And so the point here is that if the target has software with enough value to basically trigger, let's say, the whole gain on the software, in that case, the buyer will be effectively giving up 100% deductible losses, but getting 100% deductible software. And so in that case, well, it's kind of a win-win in that fact pattern, because the vendors get the benefit from the planning. The buyer doesn't really lose because it's still getting its 100% deduction. So what we're seeing now on transactions is the buyer saying, okay, that's fine. You can go about your planning. But oh, by the way, your 111(4)(e) has to trigger the gain on software. And in the situation where the target company actually has software that has sufficient value, that's great. But the issue is, well, what is valuation? You need to be sure that you have the value. And the downside of, let's say the vendor just says, okay, fine, we'll just say that software has this value. We'll trigger the whole gain on the software. Because it enjoys such a high depreciation rate, CRA looks at it fairly carefully, and they may scrutinize, is the software actually worth that much as you're saying it is? And the downside of being wrong will generally fall on the vendors. And so from the vendor's perspective, you want to be fairly sure that if you're triggering your gain on software, you actually have sufficient value in the software. And so sometimes what we'll do on transactions is say, that's fine. We appreciate that this is a possible way to bridge the gap, but we as the vendors, we also need comfort that we're not going to be reassessed. So sometimes what we'll do is we'll get a valuation of the software as part of the process. Maybe it's paid for by both parties, and maybe the deal is, well, we'll allow you to do the 111(4)(e) on software up to the value in the valuation. And so that's just something to keep in mind, because it's an interesting way to be able to possibly bridge that gap. And so the main takeaways I think here are that where a target company has losses, again, whether you're on for the company, the vendors, or the buyer, it's potentially relevant to all of them. Think about that, and in particular, consider putting it into the LOI. I mean, there's a tension between putting too much in the LOI versus not. When do you want to negotiate on it? But it's something worth thinking about. And similarly, kind of anticipating how this often goes. In a deal, think about what, if any, value the target company has in software, because again, this will fairly commonly come up, and so it's good to have a sense of that up front. And so that's 111(4)(e) planning in a nutshell. I'm going to turn now to earnouts, if I can. Okay. Continuing the theme of possibly bridging gaps. So earnouts are basically a way for parties to a transaction, typically in a share sale, not always, typically in a share sale, for the vendors and the buyers, sort of bridge the price gap as to what's a fair price. And the way this sort of works is that part of the purchase price will be set, but another part of the purchase price will be contingent on the future performance of the target company's business. So most commonly, you'll have sort of a set of financial metrics. If the target company meets this over some period of time, 1 year, 2 year, 3 years, for example, after closing, the purchase price will increase by certain agreed upon amounts. Now, from a tax perspective, earnouts raise a couple of issues. The main one being for the vendors. So at a high level, when a vendor is selling shares of a company in just a normal share sale, no earnout, for example, the proceeds are taxed as a half taxable capital gain, possibly eligible for the lifetime capital gains exemption. When you introduce an earnout, the tax concern is that there's a provision in the Income Tax Act that basically says if you receive an amount that's contingent on the use of property, that is no longer a capital gain, that becomes fully taxable income. And so the concern in the context of an earnout is, okay, when I received the portion of the purchase price on closing, that's fairly clearly a capital gain. That's okay, but what about amounts that I receive later? Are they a capital gain? Are they full income? When do I include that in income? So it raises these kind of issues, and there's not clear statutory rules that deal with earnouts. And so it creates this uncertainty, because there's a couple ways you could think about that as a vendor. The first is, okay, well, at closing, I have to include the part of the purchase price payable on closing for sure, but do I also have to include sort of the present value of the potential earnout payments? And when I actually receive those amounts, how are they taxed? Are they capital gains? Are they income? And so sort of recognizing the lack of statutory rules, and recognizing, I think, how common earnouts are becoming and have become, the CRA has a policy. It's called the cost recovery method, is the technical term. And the idea here is, if you meet these conditions, the way that the earnout is taxed is that, first of all, on closing, you only include the amount that you actually receive on closing in income as a capital gain, and then you only ever include the amounts of the earnouts if and when you receive them, and when you do, you recognize them as capital gains. And so that's sort of the ideal tax treatment. So because there's no statutory rules, it's fairly important in deals to make sure that you comply with the CRA's conditions, because the outcome otherwise for vendors is not great. And so I've listed the conditions here. Most of them are fairly non-controversial. So the parties are arm's length. Okay. The capital gain is on capital account. Generally, when a vendor is selling shares, it's going to be on capital account. The main exception is if you're a trader or dealer in securities, that sort of thing. The one piece that sometimes does come up is the earnout has to relate to the sort of the underlying goodwill of the company. And so in a normal earnout, let's say where it's the earnout's based on strictly the financial performance of the company going forward, it's fairly well accepted that that relates to the goodwill. Sometimes though you'll see provisions in the earnout that says, okay, well here's the general conditions, but we actually require that, for example, this employee stays for a certain amount of time, and it starts getting tied to certain employees. And in that case, it creates a bit of a concern as to, is the earnout really about goodwill, or is it possibly about compensating these particular employees? And so that's something to watch out for a little bit. And the last kind of final sort of black and white condition is that the earnout condition needs to end within 5 years, so it can't stretch out beyond that. And so it's quite important for the vendors to make sure that the earnout meets these conditions. That's the main tax piece for the shareholders. It also creates a couple of other issues in other contexts as well. And so one area in particular, which it always creates issues for employee stock option holders. So employee stock option holders, in sort of the normal case, let's say you're an employee, you hold a vested stock option right before the transaction. So a fairly common method of dealing with that option holder before the deal is, well, the option holder will exercise the stock option, acquire the share, and then sell the share in the transaction along with all the other shareholders. The issue that an earnout creates with that is that when the employee exercises the stock option, they have an employment benefit equal to the fair market value of the underlying share minus the exercise price. And when you're looking at the fair market value of the underlying share, i.e. the share of the company that you're going to acquire and then sell in the transaction, the CRA takes a view that, well, you need to take the present value of the earnout into consideration in determining that employment benefit. So the employee is in a situation where you say, okay, well, I know that the fair market value is at least the purchase price that I'm receiving on closing, but what's the present value of the earnout? You basically need to assign some sort of Black-Scholes model present value to the earnout right and pay tax on that amount. And you might then think, well, okay, that's maybe fine if you actually receive the amount, but what if you don't? And that's just an issue that the CRA has basically acknowledged is an issue and has basically left unresolved. And they say that's unfortunately the way the legislation works. And so it is a bit of an issue, and it's something to keep in mind and just keep an eye out for on transactions. Sometimes we'll deal with that by basically having the option holders not participate in the earnout. So maybe rather than exercising and selling the shares, maybe they'll cash out the option before. So there are some mechanisms, but none of them are particularly perfect. The other piece that earnouts sometimes create are certain tax rollovers prohibit the receipt of non-share consideration. So, for example, in certain cases where a vendor is selling shares in exchange for other shares, a share-for-share exchange, one of the rules is that you can't receive non-share consideration. And the CRA's view, I think correctly, is that an earnout is non-share consideration. It's a contingent right to something in the future, even if they're shares that you may receive at the moment of closing, for example. That's non-share consideration. And so one way to sort of deal with that is rather than having your earnout be sort of just strictly a contingent, contractual right, for example, in the SPA, is you can actually do a form of kind of special earnout share. So, for example, on closing, I might receive my normal shares, but then I receive these special earnout shares, usually a kind of a class of preferred shares that basically says, okay, well, if your earnout conditions milestones are met, then that share will be, basically worth the earnout payment that you would have otherwise received. So it's a way to sort of deal with that. And so that's why you sometimes start to see deals with all sorts of, interesting looking classes of shares. And that's often one reason for that. And the final piece here is for the most part, these earnouts are considerations for the vendors. Sometimes, though, as the buyer, um, is potential withholding where you're paying you're making an earnout payment to a non-resident vendor. And so I mentioned before that there's an income tax provision that says if you receive a payment that's contingent on the use of property, it's taxed as income. There's a similar provision for withholding tax where you make a payment, where a Canadian resident makes a payment to a non-resident that's contingent on the use of property, that can be subject to 25% withholding. And so the CRA has got a view there somewhat similar to its cost recovery method view, which says, well, if the earnout meets those conditions for the cost recovery method, we'll accept that you don't need to withhold on that. But that's an important piece for the buyers to be aware of, because it's 25% withholding that the purchaser is fully liable for, no reassessment period. So it's something to be aware of there as well. And so I believe that is it on earnouts in my piece. So I'll hand it over to Mike to talk about the mandatory disclosure rules.
Thank you, Chris. Yeah, earnouts, an interesting area. I mean, certainly we're seeing, not only are they popping up, but it seems that the quantum of them keeps getting bigger and bigger, where we're seeing deals now where, the earnout portion of a transaction may be significantly higher than the amount paid at closing. So important to keep an eye on that. So I'm going to talk about the mandatory disclosure rules. These were rules that were overhauled in 2023. They existed before 2023, but they were no one really had to ever deal with them before 2023. And then the Department of Finance amended them. So now, at least initially, everyone thought they had to deal with them. And it's been a bit of an ongoing saga. And if you've attended this M&A update in the past, we typically have an update every year as to the status of these rules. So the rules within mandatory disclosure, there's two general categories: reportable transactions and notifiable transactions. Most of the heartache is on the reportable transaction side, and that's what I'll spend most of my time talking about. In terms of reportable transaction, at a very high level, kind of the idea is there's kind of two things you need. You have to have a transaction, and one of the main purposes of the transaction is to obtain a tax benefit. And the language that describes that in the Act is very broad. So it kind of amounts to, if you're doing something that generates a tax benefit, you're probably meeting that test. And then in addition to that, you have to have one of what we refer to as hallmarks. And those hallmarks are either a contingency fee, confidential protection, or contractual protection. In the context of M&A, we really worry about the third one. Contingency fees are kind of arrangements where someone gets a fee based on the amount of tax savings. Confidential protection is not that you have confidentiality provisions. It comes down to, as you may have seen, sometimes folks will go around and say, hey, I've got this great plan. I'm willing to save tax, and I'm willing to share it with you, but you have to sign this NDA or confidentiality agreement confirming you won't tell anyone about it. So again, we don't often see that in the M&A context as well. So what we focus in is the contractual protection, which we often see, because sort of at a basic level, contractual protection amounts to, any sort of indemnity or insurance that is tied to that tax benefit. So certainly when these rules were first introduced, and they kind of had an introduction, then they were amended, and then there's been some guidance, and I'll get into that. The initial sort of reaction of many people was, well, if you have a tax indemnity in your purchase agreement, you have a reportable transaction. And so that, sort of created a lot of anxiety within the tax community. But since that sort of initial stage, the Department of Finance first amended the Act to provide, what I would call a statutory M&A exception. And I'll walk through that in a sec. And then since then, in addition to that, the Canada Revenue Agency has issued a number of clarifications as to these rules that I think have helped narrow the focus of their application in the M&A context. And I'll talk about that as well. So in terms of the statutory exception, I've set it out here in the slide. This is taken pretty much verbatim from the Tax Act. And it basically says that, if you have an insurance or an indemnity that is integral to an agreement between parties acting at arm's length for the sale or transfer of all or part of a business, where it is reasonable to consider that the insurance protection is intended to ensure that the purchase price paid under the agreement takes into account any liabilities of the business immediately prior to the sale or the transfer, and this is an and, is obtained primarily for purposes other than to achieve any tax benefit from the transaction or series. So, I think that's helped a lot in getting some comfort as to, the non-application of the rules in what I would describe as a standard M&A deal. If you just have a basic indemnity that either covers tax reps and warranties, or even a standalone tax indemnity for pre-closing transactions. But, I've underlined a few places in this definition, or this concept, that there is some subjective elements to this. So there is this reference to, it being reasonable, obtained primarily for purposes. And there are also some limitations as to when this applies. So it's only for the sale or transfer of all or part of a business. So if you have some other kind of commercial transaction that doesn't meet that, it only applies to arm's length parties. So, I think even despite this statutory exception, there was some uncertainty around the application of the reportable transaction rules in certain M&A contexts. And that kind of has led to, and has always been, kind of the core of this issue, is there's a bit of a constituency, I'd say, of tax advisors who take a view of, why not file? And I think that's driven, partly by, some of the uncertainty in the language, but probably more so by the severity of the penalties if you don't comply. And the penalties are severe. And I must say, I'll be transparent and say I'm probably not in the why not file constituency. But, I do acknowledge that the penalties for non-compliance here are severe. And you're looking at a minimum penalty of $100,000, which can be a lot higher because it's either the lower of that or 25% of the tax benefit. You forfeit certain defenses to the general anti-avoidance rule if you don't comply. And the CRA has an extended period to challenge your transaction via reassessment. So no doubting that the penalties is severe. And I think that's what's caused so much sort of anxiety within the tax community on these rules. But in terms of why not file, I guess my response to that question when it's put to me is it's not an easy filing. It's a complicated form. This isn't just a matter of you send in a one pager and you check a couple of boxes. You have to spend considerable time figuring out who needs to file it, what it should say, when it needs to be filed. I mean, this is something that is not easy to necessarily deal with. And more importantly, I think we're getting to a point where practitioners are, through a combination of that statutory exemption I've talked about, as well as the CRA administrative statements, which I'll touch on shortly, we're getting comfortable that in, as I say, standard tax indemnity or rep and warranty indemnity provisions in transactions don't trigger these rules. So I think there's kind of getting to be a bit of a market consensus. It's not unanimous, I don't think, but there's an increasing consensus, certainly from where we were, when these rules were first introduced. But, you still have issues around that, okay, well, fine, maybe there's this consensus on, what I've been calling a standard M&A deal, but what happens if you deviate from that a bit? For example, what if you do the 111.4E planning that Chris talked about? Does that change the analysis? In terms of these CRA statements, these are administrative statements, so you always have to be careful because they can be rescinded. And also they're just the CRA's views on things. They're not the law. But, the second one listed here is one that we've relied a lot in the rep and warranty, in the M&A context, where they talk about standard representations, warranties, and guarantees between a vendor and purchaser, as well as traditional representations and warranty insurance policies that are generally obtained in the ordinary commercial context of mergers are not expected to be reportable transactions. So you'll see some of these subjective terms in there as well. Standard reps and warranties, generally traditional, so there is still, some scope for uncertainty as to whether or not what you have is traditional or standard. But, again, I think this combined with the statutory exemption and some of the other statements has helped people get comfortable with these rules. I've attached a link in the slide to these statements. And it's interesting because if you go to that link, and I didn't go to it this morning, but when I last checked it, there are now 113 separate points of guidance on your reporting obligations for reportable transactions. So, not to editorialize too much, but I think that speaks to some of the problems with the provision that it's required the CRA to provide 113 separate clarifications in under 3 years. But, as I say, I think that list, will grow and presumably grow in a way that will build on that consensus, hopefully, that the reportable transactions are not going to be triggered in standard M&A agreements. But the flip side of that is I found that is more there's more and more specific guidance. Parties seem to be taking a position. Well, given that there's these 113 statements plus the statutory exemption, if we're finding ourselves that we don't fall within one of those 114 statements, I guess, that must mean that we have a problem. And so that seems to be kind of the growing consensus that if you don't have a specific statement, you again should go back to the why not file position. And again, I don't know if that's really what was intended by the clarifications, but that seems to be what's happening. And certainly we've seen in our office that where we were in a situation where there wasn't a specific clarification, but we were getting insurance, that the insurer effectively made a condition of giving the insurance that we report. So there's certainly the rules have not gone away. But as I say, I do think they're narrowing considerably. In terms of, what we recommend to do, again, always same advice we've pretty much been giving since the beginning. Try to identify the issue early, figure out whether you do fall within a safe harbor or whether you're outside one of those 114 statements. And we see increasingly within the documents provisions dealing with reporting process. So the parties agreeing to cooperate to determine if they have an issue, and then cooperating to the extent they agree they do and have to report. And that sort of lends itself to the next point, that early engagement with your counterparties to make sure you're all on the same page, because there still is I think that some pretty significant divergences of view within the tax community on these rules. So it's important to get the perspective of the other party early on. And then finally, what we're seeing now is part of the standard package of reps and warranties in an M&A deal is a representation as to past compliance with these rules. So that seems to be, now the impact of that. So that's reportable transactions. Notifiable is in some ways a lot easier, because notifiable transactions are transactions or substantially similar transactions to a list that the CRA provides. And I've attached a link in the slide to that list. Currently, that list is, I think there's 4 or 5 transactions on it. And they're all pretty technical transactions dealing with sort of what one might call aggressive tax planning, or maybe, to be more generous, creative tax planning. That I think in the ordinary course you're unlikely to see in an M&A transaction. But again, it's sort of standard process. We always check for updates and keep our eye on updates to see if anything is, because notifiable basically isn't the sort of subjective element. If you're a notifiable transaction, you have to report. You don't have to look at the hallmarks or the benefits. It's just if you're notifiable or substantially similar to notifiable, you have a reporting obligation. Okay, moving on to common due diligence issues that are tied to tax. I've got 5 I'm going to talk about today: SALT, valuation, transfer pricing, QSBC status, and EIFEL. And I did this by design. It wouldn't be a tax presentation if there wasn't a whole bunch of acronyms. So we've got 3 different acronyms in there, but we'll walk through each of those. The first one is SALT, which is state and local taxes. So this really got to be, I think, an issue, 3 or 4 years ago, I'd say, and it impacts, I think, particular industries more than others. We see it a lot in the software space, and the origin of it is there's jurisdictions, and I say primarily in the slide, but it might actually be exclusively. I don't know if I've really run into this in non-U.S. jurisdictions, but there are states and either sub-state governments in the U.S. that take a fairly aggressive approach to what we might call tax nexus. And by tax nexus, I mean, generally the ability to tax someone. And really, what we see most of the time that triggers this, and there are variants that employees in the jurisdiction, but the one that I think trips a lot of people up is customers. So this idea that you might be in Calgary, and all your operations are in Calgary, and all your employees are in Calgary, but you sell to people in Kentucky, and you just sell to them maybe online. I think for a long time people wouldn't have thought they would be exposed to Kentucky tax in that example, just given the nature of the complete non-presence in Kentucky other than selling to people there. But these rules, in various U.S. states do extend to that type of relationship. And they all have different sort of thresholds and de minimis tests and other things. But I think for a long time, people were just not aware that they were tripping up these taxes. I think people are becoming aware of that now through experience and it's being socialized. So the compliance is getting a bit better, but sometimes it's, the historical compliance is still problematic. The working from home situation has probably made this challenging because employees are often a nexus. And so, if unbeknownst to you, a work from home employee has decided to move down to California, which is very much an aggressive state when it comes to this stuff, it may trip up issues that you weren't expecting. So in the M&A context, the way we, generally approach these is obviously it's a subject of due diligence at the outset. If there are problems, then depending on the nature and quantum of the problem, there may be a special holdback to deal with these taxes. Most of these jurisdictions have a voluntary disclosure process that allows you to sort of deal with late reporting and perhaps, allows for the alleviation of some of the penalties. And so there may be a provision in the governing document, the M&A document, that talks about how that process will be undertaken. So, so that's typically how we deal with things. And as I say, I think the good news is I think people are becoming aware of this and it's less of a surprise than it used to be, but there is still, an ongoing issue there. Valuation. We're seeing a lot of CRA activity on valuation in kind of all sort of spheres, but including M&A. And again, in the context of due diligence, where we might see that this would be relevant is if you're looking at a target that had previously undertaken an internal reorganization, and that internal reorganization sort of depended on valuations, then, if in doing that, the party didn't obtain third-party advice and instead kind of undertook these transactions based on internally generated valuations, you may have an issue there because the CRA, at least in our experience, seems to be completely discounting internal valuations as not having much value and not feeling bound to sort of follow them at all. And so this is an area where, we do keep an eye on. And another issue that kind of comes out of this is, when we're doing due diligence, we'll often be aware of the statute of limitations and sort of say, well, typically the statute of limitations, the ordinary course is 3 or 4 years. Can be extended in certain circumstances. And so you might look back and say, okay, well, our review will be for 5 years. But the CRA and these valuation challenges often takes a view that a bad valuation amounts to gross negligence, and gross negligence allows them to challenge you outside of the reassessment period. So, I have a file on my desk now where they're purporting to challenge a 2016 valuation, 10 years later. So that's some of the issue that kind of comes with this is not only the substantive nature of the problem, but the fact that it may go beyond where you would normally think tax problems could arise. Okay, moving on. A secondary valuation on stock option, which is an interesting issue. So stock options, as some of you might know, in Canada for employees, when you exercise a stock option, the difference between what you paid and the value of the share you received is an employment benefit. But there are rules that allow you to reduce that employment benefit by 50%. But one of the conditions for those rules is that the fair market value of the option, the exercise price of the option was equal to or greater than the fair market value of the underlying share at the time the option was granted. So basically, the option wasn't granted in the money. So if the share was worth $1 at the time the option was granted, the exercise price is $1 or more. And as I say, if you meet that condition, there's a strong likelihood that on the exercise of the option, you'll be able to reduce your employment benefit by 50%. But that raises the question of when options are issued, what sort of support is there for the valuation of the underlying shares? And this impacts not only the holder of the shares, but the company that issued them has to deal with this issue, because when it withholds, if it has to withhold on either an exercise of options or sale of options, or when it files a T4 for the options, which you would have to do, it has to basically decide whether the employee was entitled to this 50% deduction, because either they will reduce their withholding by 50% or they reduce the amount reported on the T4 by 50%. So it's kind of it impacts the company directly as well as impacting its employees. And so we are increasingly seeing, as part of M&A deals, purchasers wanting support for how the company determined fair market value at the time it granted its options. And this has led to discussions, on an ongoing basis with clients about trying to formalize their process, because we do see situations where kind of options are issued throughout the year, and in determining fair market value, a company might just rely on, the last financing it did, which might be 6 months or more old, And so we're sort of pushing people to say, well, maybe you should only be granting options at a certain point in time. So, once a year, twice a year, once a quarter. And at that time, you will have obtained a methodology, ideally from a third-party evaluator, that lets you determine the fair market value at that time, because I think you have to be a little bit more careful now about the pricing of these options. Transfer pricing is always an important issue where you're dealing with a deal where you have a target entity that has a non-arm's length cross-border entity, so a subsidiary or parent or whatnot. And again, the basic principles of transfer pricing are all arrangements, all cross-border arrangements between non-arm's length party have to be at fair market value to ensure that the various jurisdictions get their fair share of income and presumably tax. And moreover, in Canada, in order to make sure that you've been conscientious about this, you have to maintain documentation supporting the values you used. And if you don't, and it turns out the values you used were incorrect, there's additional significant penalties associated with that. In recent years, the government has lost a couple of pretty high-profile transfer pricing cases, and is often the case when the government loses, they then go back to the Tax Act and amend it to ensure they don't lose the next time. And they have sort of announced their intention to do this, or at least consider doing this in a transfer pricing context to address some of the issues that cause them to lose these high-profile cases. So again, I think those rules are still being discussed, but I think going forward, transfer pricing is going to become even more of an important issue to consider. And in addition, we're seeing an area that traditionally transfer pricing, we didn't really see it applied to, was sort of cross-border interest rates. But the CRA has taken some action on that front. So this is definitely an area where we're seeing some more activity and anticipate more activity, pending these, what we say would be anticipated changes to the transfer pricing rules. QSBC. So a qualified small business corporation, the shares of a QSBC are entitled to a lifetime exemption on up to $1.25 million in gain, which, depending on what province you're at, is roughly $325,000 of tax savings. The key requirements to QSBC are that shares be of a Canadian-controlled private corporation. They have to be held for more than 2 years. And then the key issue for the purposes of this presentation is at the time of sale, 90% of the assets of the CCPC must be used principally in an active business carried on primarily in Canada. So why we're talking about this today is we're increasingly seeing with the sale of private companies that shareholders will, either during the transaction or more often after the transaction, be looking to the company. And if it's after the transaction, they're effectively almost looking at the buyer at that point to give them some guidance on whether or not their shares qualify for the capital gains exemption. And certainly one approach to that is just to say, well, we can't do anything for you. But I think we often see that, the company wants to try to help them, to the extent they can. And we certainly would never recommend assuring anyone that their shares qualify for QSBC. But we do think it's worthwhile for all parties to look at in the course of the transaction whether or not they think, based on the information they have, that the shares qualify. And then that can be messaged in a way to the shareholders to say, this isn't binding, but in our view, we think they do or we think they do not. And it also, this 90% test that I reference here is only applicable at the time of sale. So again, as part of a due diligence process, you might realize, well, we don't meet the 90% test, we're at 80%, but we can undertake some transactions prior to closing that would get us to 90%, and allow people to claim their capital gains exemption. So for private company M&A, I think it should be a fairly standard item on the checklist to think about QSBC status. Moving on to Eiffel, the excessive interest in financing expenses, which started for tax years starting after October 1st, 2023. I think it's fair to say I've been practicing for over 25 years, and I think the Eiffel rules may be the toughest rules I've seen. It's just brutal legislation. And I wouldn't even attempt to kind of get into it. I mean, basically the Eiffel rules limit the deductibility of interest. And why I did raise it today is we often see that when there is complex legislation, that makes its way into M&A agreements because people say, well, now we want assurances that you've complied with this complex legislation because we know it's a nightmare. And so we're, starting to see M&A reps and covenants around compliance with Eiffel. And so that, of course, if someone was inclined to give a rep as to compliance with Eiffel, they of course have to be comfortable that they complied with Eiffel or provide the necessary disclosure describing why they didn't comply with Eiffel. And I think, frankly, in my view, this isn't driven, I don't think this is driven in some cases by, oh, we're worried you have a big cash tax problem, i.e., you'll owe a big liability because you didn't comply with Eiffel. I think it's more buyers looking at this and saying, if we acquire you, how much work are we going to have to put into making you Eiffel compliant? Like, have you done a good job so far so we can take over your records and be in good shape, or are we starting from scratch? So I think it's, kind of almost an inquiry on those lines. And certainly from the sales side, I think given the complexity of Eiffel, the initial reaction would be pushing back on any reps that deal with it because, I think if you talk to your tax folks, if you have them, or your accounting advisors or whatever else, and you say, hey, listen, I need to get comfort that we're good on Eiffel, they're going to be very, stressed out about that. And it may be unavoidable. But if there is the possibility at this stage to push back, that would be one I would, again, on sell side embrace. Okay, I'm going to wrap up now just talking very quickly about lockbox agreements, which in addition to being difficult to say, is we're seeing an increase in use in Canada. And there's significant differences for Canadian tax purposes. You kind of approach these things, differently than the standard kind of M&A acquisition agreement. And I'll talk about that a little bit. Now, this is not intended to be like a full description of lockbox structures because there are variants on them, and it's a very interesting issue, outside of tax. But basically, the structure, and maybe a typical, if you could call it that, LB structure is you fix a lockbox date. So maybe March 1st, 2026. So that's a critical date because from that date forward, effectively the economics of the company are for the benefit and bear the risk of the buyer. But then you have a due diligence period. And depending on the complexity of the business, that period could be longer or shorter. Here I'm saying, let's say March 1st to April 30th. And so during that period, the buyer really delves into the business, figures everything out. And as part of that process, an agreement is then signed after that due diligence process. So this example on May 1st, 2026, that fixes a purchase price. And that purchase price is determined as of March 1st, 2026. So we say that's our lockbox date purchase price is X. Then you may or may not have an interim period. You would, for example, if you needed to get some approvals or consents or whatever, but it's not necessarily part of the lockbox structure. And then the deal closes, if you do have an interim period after that interim period, and it's the same purchase price, less leakage. So that'd be, let's say, on June 1st. So you have your purchase price and you close there. So there's no pre-closing adjustments for working capital. There's no post-closing adjustments for working capital. Instead, it's just your purchase price. And again, less leakage, which I'll talk about. And leakage is basically, the concept, there's leakage and permitted leakage. So leakage will reduce the purchase price. Permitted leakage does not. And Permitted leakage generally includes taxes as of the lockbox date and taxes incurred in the ordinary course since the lockbox date. So effectively that, to the extent there's taxes, there will be no adjustment for the purchase price for those ordinary course items. Where you might see leakage would be a pre-closing distribution. So if you said, well, we want to push some cash out of the company prior to closing, that would not be permitted leakage. And there's two ways that that might be dealt with. One might be that they simply reduce the purchase price by the leakage. The other might be there may be a prohibition on leakage. So that would say you can't do something that constitutes leakage because we have to preserve the integrity of the purchase price. And so from a tax perspective, the locked box deal structure puts a significant emphasis on due diligence. Because again, you're not going to have the ability necessarily to true up tax at closing through a working capital adjustment or post-closing with a closing day adjustment. So you have to get comfortable on the tax situation of the target. Likewise, generally in lockbox deals, there may be very limited indemnities. So if there is a problem with the taxes, you may not have recourse to the sellers. Because of that, it's a structure that I think lends itself to insurance in order to backstop, I guess, your due diligence to make sure that you've analyzed the tax correctly. And as I mentioned earlier, it may contain a prohibition on leakage, in which case you may be limited in your pre-closing planning. So, to the extent we often see a dynamic of people, saying, okay, well, we'll sign the agreement, we have an interim period, and we'll figure out if we want to do any tax efficient tax planning. You may now have to do that up front, because it may not be an opportunity to do that, once you've set your lockbox date. So as I say, I think a very different dynamic than kind of what I would say is our traditional M&A tax sort of provisions. The final piece of this I'll talk about is often there will be what sometimes will be referred to as interest on the purchase price that it looks like interest in the sense that it's calculated as a percentage of the purchase price. So it might say, there's the purchase price, and then from the lockbox date to closing, it'll be, increased by 5% calculated on an annual basis. Sometimes this is referred to as a ticking fee. From the seller's perspective, we always want to emphasize that it's not actually interest in it, and instead it's additional proceeds of disposition, because that's generally taxed better than interest. I think the good news there is I think that's the correct legal characterization, because although the parties may call it interest in the agreement, I don't think it has the legal characteristics of interest, because it's not payable if the deal doesn't close. There isn't an actual debt. So I think that, again, I think it's an ongoing sort of discussion, but I think the general view is it's probably not interest. And I frankly, when I see lockbox agreements, I try to change the reference to interest to something else just to avoid any confusion on that front. So again, I suspect next year in our update, we may be revisiting some issues that arrive out of the increased use of these agreements, but definitely wanted to highlight sort of what we're seeing so far. And with that, I think we are wrapped up. You'll see the QR codes I promised in terms of getting credit, so please take that. We do have a few questions, so maybe I'll just quickly look at that. Chris, have you had a chance to look at the questions?
Just looking out here.
Yeah, the first one I could take, although it's yours because I think it's fairly straightforward, is the 111.4e planning primarily for private company M&A transactions, or could public companies use it as well? Yeah, it's for private companies. Public companies don't have CDA, which is the sort of, as Chris pointed out, the critical component of being able to do it. So I think it would be limited to private companies.
Yeah, look, get the second one there. Sorry, just because it's also on 111.4e here.
Yeah.
Question being, could the target company trigger a gain on internally generated goodwill and pay a cash dividend pre-acquisition in order to purify the company for lifetime capital gains exemption purposes? So also actually, Mike, tying into yours a little bit, but yeah, I think they can. Yeah, the nice thing I mentioned is that the CRA has generally accepted that yes, you can trigger the gain on internally generated goodwill. Historically, there was a bit of an issue as to whether or not you could, and they've helpfully said yes. And yeah, so if you have actual cash to pay and you have other reasons for doing it, such as purifying for capital gains exemption purposes, which is good for those purposes, yeah, you can do that as well. You don't need to do our sort of paper notional capital dividend. The key there would be is you'd need to then also make there's a specific tax election that the target company needs to do to declare that to be a capital dividend. So you need to do that as well. I think the next one's yours, Mike.
Yeah, is the reporting obligation for a reportable transaction the vendors or the purchasers or both? It's a good question, and it highlights why I'm not one of the why not file constituents, because that's a complicated question. And that often, when you do get into these rules, there's a lot of debate about that. And, there may be an interpretation of the rules that it's strictly for the benefit of the vendors because they're realizing the tax benefit. But then there's an argument that the purchasers benefit because to the extent there's an indemnity to your insurance, they're covered. The shareholders involved may also benefit if the tax, for exactly 111(4)(e) planning, which doesn't benefit the company, but benefits the shareholders. So, one of the problems with reportable transactions is, as I say, if you do say, fine, let's file, determining who actually has to file can be a huge headache. And then it often becomes a question of like, well, if one party is going to file, given the penalties, if the CRA is going to know about it anyway, maybe we should throw a filing in there too, just to make sure that if there's any risk that we get caught in this thing again, given that there's going to be a filing, we should piggyback on it. So, short answer is yeah, it depends on the facts who has to report, and that can be a difficult process to sort of go through. And then the final question there is if a stock option is issued by a public company, can the trading value be considered as the FMV for valuation purposes? Generally, I'd say yes. I do think the CRA has made statements that they want you to be consistent in the application of trading values. And I think they prefer kind of a window, like what they would want to avoid. And you might run into an issue is if, on say Liberation Day, your stock had tanked by 15% and then you immediately issued a bunch of options, the moment after that, and then the stock goes up the next day, they might sort of say, well, that seemed like you were manipulating the price a little bit. But I think absent that, if you use a model based on trading value and you use it consistently, I think you're in good shape in terms of, demonstrating fair market value. I don't know, Chris, if you agree with that or have anything to add.
Yeah, no, I completely agree with that.
All right. Well, I think that's we wrapping up 1 minute over. So appreciate everyone staying for 1 minute. And thank you very much for being part of this. If you do have any additional questions, feel free to reach out to either Chris or I, and we're happy to take them. And you'll probably be receiving an update in a few months as to the next in this series. So thank you all for taking the time today.